Hi, I'm Amalia Suruni. I'm currently taking a corporate finance course at IPMI International Business School. I'm a part of the EMBA class of September 2022. My lecturer is Professor Sembel. The objective of the course of the corporate finance is to give the students problem-solving skills from the points of view of management, internal, and investor, which is external. So let's begin with the ending. We have several assignment, group and individual work. The first work that I did with my group is the book review, Common Stock and Uncommon Profits by Philip Fisher. You can check the link in the description below. The second group work that we did is the event analysis, where we analyzed the SLB of Japfa Confit. And another group work, which is the portfolio investment. We worked on the portfolio investment of 3 different companies. We choose CPIN, BMRI, and DLTA. You can see the final results below. Let's move on to the individual work. One of the final work that I have to do is to make a company report of BMRI as a part of my portfolio investment project with my group. The second individual work will be the journal, and the last individual work will be this mind map. So let's start. The first category that I want to show you is the financial management. We start with the new vocabularies and then the goal and what to manage. We know that hot money equal to funny money. And then we move on to optimal orchestration. See here there's a conductor, but not conducting the orchestra, but conducting the finance. Which is the meaning of optimal orchestration is the internal plus external financial resources is equal to significant and sustainable value creation. The next one is the principal agent problem. We call it tariff. Is the abbreviation of transparency, accountability, responsibility, independency, and fairness. Next one, there are 5 businesses essential by Professor Ramcharan: cash, profit margin, velocity, growth, and customer focus. And then don't forget about risk management. The conclusion of this topic will be high risk, high return, and low risk, low return. The next part is the 4 cornerstones of corporate finance. The first one is core value principle, followed by conservation of value principle, and then the expectation treadmill principle, and the best owner principle. The last part of this category will be corporate values. There are 3 corporate values. The first one is tangible assets. Inside the tangible asset, there is a physical asset and financial asset. The next one will be intangible asset. There are employee and supplier assets, customer assets, organization asset, and reputational asset. And the last one will be value creation and sustainability. Let's move on to the second category. We have capital budgeting. The first note that I put is beware of investment fraud. Inside capital budgeting, we have compound value. Inside the compound value, there are future value, present value, the rule of 72, and time value of money and its application. After we discuss about that, we also talk about the concept of capital budgeting. There are 4 concepts. The first one is estimating the cash flow, including initial outlay, operation cash flow, and terminal cash flow. The second one is evaluating the project based. The third one, then we can decide is it good or bad. And then the last one, if you have 2 or more projects, it can be mutually exclusive or independent. We move on to the method of capital budgeting. There are 4 methods. I put it here, 4 methods, and you will see later why I blocked number 2 and number 4. So we discuss number 1 first, which is a payback period. There are plus and minus of this payback period. The positive one is you can calculate approximate year to cover the initial investment. But there are some minuses. This method is subjective. It's not considering time value of money, required rate return, and all of the cash flow from the project. The second method is net present value. I put some formula here, you can see. And then the third one is profitability index. There's some decision rule that I put here and the formula. The last method will be internal rate of return or IRR. It's the discount rate that makes the net present value, the method number 2, equal to 0. I also put the condition here that you can accept if IRR is more or equal to required rate of return, and then reject if internal rate of return is less than the required rate of return. In method 2, 3, and 4 is objective because it's considering time value of money, RRR, and all cash flow from the project. Number 3, we will discuss about analysis of securities. Okay, in my mind map here, I put the first one is you need to know about investment strategy before making any decision. And then you also need to know about the framework of fundamental analysis, which including domestic and global economic analysis, industry analysis, and company analysis. Next one is intrinsic value versus market price, followed by fundamental indicators, and then this one is important, understanding financial statement. You need to understand about income statement, balance sheet, and the cash flow statement of the company. After you understand the financial statement, how to analyze the financial statement. I put 5 things that you can analyze from the financial statement. Is the profitability, liquidity ratio, activity, leverage, and market ratio. After you calculate that, all of them, you will know that whether the company is healthy or not healthy. You can also see by this standard or DuPont analysis. I put the example here how to count the DuPont analysis, which ratio that you need to have and compare it with the competitor. The next one is the technical analysis. What is technical analysis? It's finding repeated pattern in the price graph. There's some technical analysis that you can use. I put some of them, you see on my screen. Next one is the interesting part, is portfolio theory. It is about potential and actual return, probability weighted versus simple historical average, total risk, systematic and unsystematic risk. You can see in the picture here how low risk, high return is connected. It's called efficient frontier portfolio. And I put a note here that volatility of your graph will be connected to the risk. And then we move on to the CAPM. Is from William Sharp, Nobel Prize winner, great grandchildren of a Nobel Prize winner. Thank you, Professor Roy. And this is the formula. I put the formula here about the expected return. We discussed in the class that risk-free rate that we can use is between 3 to 5%, and the MRP is between 8 to 10%. And we also learned about how to calculate beta using regression and slope tool in Microsoft Excel. Last one is about WACC, or weighted average cost of capital. It's total equity and total debt. You can see here, I put the formula and the chart. Enjoy. Number 4 is capital structure and dividend policy. What's the difference between financial and capital structure? Capital structure is all about long-term source of fund. So if you go to balance sheet, you're gonna take a look of debt and preferred. Also shareholder equity. I also put the theory of capital structure. It's important. It's from Modigliani and Miller. You can see here. Next one is managing total cash flow. You also need to be careful of financial distress, and this is the process of integral financial distress. You don't want that. You don't want your shareholder to be stressed. Okay, in the real world, the firm attempt to balance the cost and benefit of debt. We also have a interesting case about RGR Nabisco. The lesson learned is about LBO or MBO, sources of gain, ethical issue, and conflict of interest. Now, dividend policy, should we pay for dividend policy? Do we have to pay? Yes, we have to pay. Dividend policy will tell you how much the firm's earnings should be distributed to the shareholder as dividends and how much should be retained for capital investment. Number 5 is fraud risk management and corporate restructuring. But the first one is about restructuring and recovery. We have a case from Professor Roy, his experience in corporate restructuring and surviving and transforming business. Is some take points. The first action that you need to do is to stop the bleeding, secure the cash, and then financial restructuring, temporary pivoting, strategic realigning, redefining core business, and new ways of doing the business. Okay, and then we also have some metrics from Boston Consulting Group and McKinsey 9-cell matrix. Speaking about fraud risk management, you need to know about the 7 financial shenanigans. It's recording revenue too soon, recording bogus revenue, boosting income with one-time gains, shifting current expenses to a later or earlier period, followed by failing to disclose all liabilities, shifting current income to a later period, and shifting future expenses into current period. Be aware also about the occupational fraud and abuse, and if you understand that, you can also analyze later on about the fraud statistic. Number 6 is international finance and recent issue in finance. We talk about serendipity, and then there are 4 types of incentive, which includes physical, monetary, social, and moral. We also talk about conglomerate discount. And we have movie review. I have this, Wall Street. This is some lesson learned from all of the 4 movies about risk management perspective and suggestion, arbitration, unauthorized transaction, merger versus acquisition, subprime mortgage crisis, greed is good. In this case, yes, greed is good. And then ethical versus legal and unethical versus illegal. Move on, we have foreign exchange market and transaction. And then we discuss also about currency futures and options market. And then arbitrage. I put 3 things about arbitrage in Forex, is including locational, triangular, and interest rate. And the last one is signaling theory. The last category that I want to show you today is efficient market theory. To learn about efficient market theory, you can start by studying the topic from the winners of the Nobel Prize in Economy. There's EMH, which is the efficient market hypothesis. After EMH, there's implication of efficiency for investors, and then information of price movement, perfection and imperfection of capital market, confirmation and anomaly against EMH, and strategy in an efficient market. Is the market efficient? The answer, market is not a black and white, it's a spectrum. Thank you, Professor Wright. Speaking about efficient market theory, don't forget about rational versus irrational, and then passive versus active investment. So that's it for today. Thank you for watching my video. If you like this video, please subscribe and press the like button. Thank you.